Large cap funds are generally a part of core portfolio of majority of mutual fund investors. We invest in large cap funds for providing a stability to the overall portfolio. In today's video, we will discuss about one of the most popular large cap funds, that is Axis Bluechip Fund, and check its performance using real data. And by the end of the video, we shall be able to decide whether to continue our investment in this fund or should exit this fund now. And if we decide to exit this fund, then which fund to go with. So please watch the video till the end. Hello everyone, I am Dhaval and welcome to my channel DIY Finance. This video is my second video on Axis Bluechip Fund. I had made earlier video on 12th of March 2022. Link is attached in the I button and also in the description. You can check the same from there. To start with, we all know that Axis Bluechip Fund has been one of the star performers in its category, that is large cap category. Here we'll be taking into consideration data of direct plans only. Firstly, let's look at the basic details like AUM, that is total asset under management, which is around 36,900 crores, which is little on a higher side, while the expense ratio is 0.55%, that is around 0.5% and quite low as compared to other schemes. The benchmark index, that is the reference against which the scheme is compared, is BSE 100 TRI. Now let's look at the sector-wise allocation and compare it with its benchmark. From the graph, it is very clear that the fund is heavily invested in finance, followed by technology, services, automobile and material. Finance and technology are the core sectors, and quite a few large cap companies form a part of this sector. And when we compare the sector allocation to its benchmark, it is quite different, especially for finance, energy, and consumer staples. Here, around 38% allocation is toward financial sector, and such large allocation in a single sector can hamper the performance of the overall portfolio. This thing we'll check in the later part of the video also. So now let's check the top holdings and portfolio allocation. As evident, ICICI Bank, Bajaj Finance, HDFC Bank, and Kotak Bank are the main stocks of the financial sector. Infosys and TCS are from the technology sector, whereas Avenue Supermarket is from the service sector. Here also, the stock selection looks good. On checking the portfolio allocation, it is evident that the large cap shares form around 99% of the portfolio and only negligible 1% is allocated to mid cap shares. Here also, the allocation is quite different from the category. If you also check, the fund is having a debt allocation of around 11%, which is not normal. This type of portfolio allocation should provide a very low volatility and a better downside protection. But an over conservative approach can also hamper the performance of the fund. So now let's look at the fund manager. Mr. Shreyas Devalkar has been managing the fund since November 2016, and that too very efficiently, and hope that he continues in future also. Here, this long-standing association of the fund manager with the same scheme is quite positive and an advantage for the scheme. Now let's see how the fund performs on risk parameters. Here, we compare the parameters with the benchmark index and category average. First, mean return, that is the average return in a year, which is 14.56, which is less than both the category average and the benchmark. Here, higher the value is better. Second, standard deviation, that is a tool to measure how much the return has deviated away from the mean return, which in this case is 18.96 and is less than both the benchmark index and the category average. Here, lower the value is better. Third one, Sharpe ratio, that is a tool to measure the risk adjusted return here, which is 0.58, which is less than both the benchmark index and category average. Here, higher the value is better. Fourth one, beta, that is the volatility of the scheme compared to benchmark, which is 0.81, which is less than the category average. Here, lower the value is better. Fifth one, alpha, that is a tool that measures how much better the fund has performed compared to the category. Here, it is minus 0.89. Generally, this value should always be positive and more than the category. But here the value is less than the category average. Here higher the value is better. Hence, after looking at all the risk parameters, it can be concluded the fund's performance is quite poor on the risk parameters. Now let's compare the trailing returns. On comparing the trailing returns for 7 years, 5 years, 3 years, 1 year and less, it is seen that for periods 3 years and less, it is not able to beat its benchmark or the category average. The underperformance of the scheme for such a long period is not a good sign for a fund. Now let's also check the calendar returns and see how the fund is consistent in its performance. On checking the calendar returns for last 8 years, that is from 2014 to 2021, the fund has been not that inconsistent in its performance. That is, in the year 2014, 17, 18, 19 and 2020, it had outperformed its category and benchmark. Whereas for the year 2015, 16 and 2021, it has underperformed than its category and benchmark. Now let's also check the performance for the first 3 quarters of 2022. Here also, if you see, fund has underperformed for the first and second quarter of 2022. Whereas for the third quarter, it is almost same as that of the benchmark and category. Hence, it can be concluded that the fund is not that consistent in its performance, and especially in the last 2 years, it has underperformed. Now let's also see the rolling returns. On checking the rolling returns for 5 years, 3 years and 1 year, it can be observed that the performance of the fund is better than the benchmark and has been able to beat the benchmark 100% for 5 years period. And for 3 years and 1 year, it is 96% and 71% respectively during the returns period, which also indicates that the fund's performance is quite good across 5 years period, but is not that good for 3 years and 1 year period. Now let's also see the upside and downside capture ratios. The upside capture ratio is the measure of how the fund performed relative to the index during the period when the index rose. Here the value is 87, which indicates that the fund underperformed 13% less than the index during the rise period. Here, higher the value is better and should generally be more than 100. The downside capture ratio is the measure of how the fund performed relative to the index during the period when the index had dropped. Here, the value is 91, which indicates that the fund declined 91% as compared to the index during the fall period. Here, lower the value is better. Here, both the upside and downside capture ratios are not good, and with a higher allocation to large caps and even more debt allocation, the fund is having a poor downside protection, which is really bad for such a high rated fund, and the fund manager has to act upon this situation to improve the performance of the fund. Now let's see the risk return graph. Here on x-axis we have standard deviation, whereas on y-axis we have total returns. It is very evident from the graph that the fund has lesser total returns value with lesser standard deviation as compared to the category average and the index, which indicates that the fund is surely having a lesser volatility but is not able to generate better returns than the category and index. Here, on almost all parameters, Axis Bluechip Fund performs poorer than the benchmark index and the category average, which is not a good sign for a fund. So now coming to the conclusion, what investors should do. Before concluding this video and suggest what investors should do, I would request all of you that as you have watched the video till now, it seems that the topic is of your interest. Hence, I would request all of you to press the like button and also subscribe to my channel to watch such interesting videos in future also. So now let's look what investors should do. First, the existing investors. The fund performance has been poor since more than 2 years, and in last 1 year, it has deteriorated quite a lot. This poor performance is not only limited to this fund, but the overall category of large cap has been underperforming since last 2 years. I feel time has come to switch from actively managed large cap funds to index funds, especially in the large cap category. Some people may argue and feel that if you see the performance of this fund for 5 years and more, it is quite good. Hence, should not switch to other funds, as mutual fund is a long-term investment. But I feel that the time has come that one should switch to large cap index funds, as I don't feel that in coming time actively managed funds can outperform its underlying index. This is my personal opinion. Do share what you think about it in the comment box. You can please check my earlier videos on index fund also. Link is attached in the I button and the description. Second, for the new investors. Instead of starting a new investment in Axis Bluechip Fund, I feel one should start investment in any of Sensex or Nifty index fund from HDFC, ICICI or IDFC fund houses. I would like to add that I have Axis Bluechip Fund in my portfolio, but I have stopped SIP for the same and started SIP in the IDFC Nifty 50 index fund. Please subscribe to my channel if you have not done till now and also press the like button. Do check my older videos. Link is attached in the cards. Thank you.